Hello, everyone. Today we are talking about equity index futures in the US market. And more specifically, not only understanding the various equity index futures that we can trade and their contract specifications, but most importantly, being very practical, if you wish, when it comes to understanding which one should you trade, because they all have different characteristics beyond the contract specifications. So let's begin here. We have the S&P 500 futures, which is the one I have on the screen, as you can see here, with the symbol ES in TradingView ES1 exclamation mark, with lead you to chart the continuous contract. We have that. We also have the NQ, which is the Nasdaq 100 futures. We also have the Dow Jones Industrial Average Index futures, as well as the Russell 2000 index future symbols YM, as well as RTY. Okay, so to know a bit more about them, just so also you know where to get the information from, I'm just going to bring very quickly the CME website, where you can see that if you were to go to markets and you were to select equity index, you would basically end up in this page where we can see that the key markets are S&P, ES for E-mini S&P 500 futures, NASDAQ, NQ for E-mini NASDAQ 100 futures going down. We have the Russell, RTY for E-mini Russell 2000 index futures, and a bit lower we have the Dow Jones YM for E-mini Dow Jones Industrial Average Index futures. Okay, so by clicking on any of those, basically we would end up in their corresponding page, where very conveniently we can look at the contract specs. Starting with the S&P, we can see how 1 point equal $50. Then going to the NASDAQ, where 1 point equal $20. Continue with the Russell RTY, 1 point $50 as well, and ending with the Dow Jones, where 1 point is $5. So the first impression by looking at those contract specifications, which is the point today, which is not necessarily the way you want to think about it, is that okay, well, the Nasdaq is 20 points, the S&P is $50 per point. Sorry, let me repeat that: $20 per point for the Nasdaq, $50 per point for the S&P. And therefore, maybe the conclusion is, look, I have a smaller account, maybe I should be trading the Nasdaq. I have a larger account, maybe I should be trading the S&P. And this is putting on the side that we also have the micro contracts, which I'll discuss later, which are 10 times smaller. So you have the micro S&P, the micro Nasdaq, the micro Dow, and the micro Russell, right? So you can also go for the smaller size contract, where everything would be 10 times less. So in the end, you're facing 50 against 20, or you are facing 5 against 2, which is 10 times less, right? So going back to the original point, which one should I trade? Should I trade the Nasdaq because it's $20 per point, or should I trade the S&P, which is $50 a point? And while this is obviously very relevant to understand the point values, the way I think about it is that we also need to mix, together with understanding the point values, we also need to mix understanding the nature of all these various different markets, because some markets are more volatile than others. Therefore, what I'm going to do here is to use a daily time frame. I'll start with the S&P ES. And what I'm going to do is I'm going to add an indicator. I'm going to go for average true range, ATR, which tells us as an average how many points per day this market moves. How many points per day, because I am charting a daily time frame. And the average in this case is ATR 14, which is kind of like the standard default. So in the last 14 days, as an average, the S&P has been moving 88 points per day. So what does that mean? Well, if we bring in a calculator to the screen, so we can do some easy calculations, which is, we know, we saw the contract specs for the S&P futures is $50 a point. So we now know that one typical day of movement as an average for the S&P would be 88 points. So in other words, if you were to be a super trader, catch the low of the day, ride it all the way to the high of the day as an average, you would produce 4,400 US dollars per day per contract. Okay, of course, as traders, especially if you trade intraday, you don't target to catch the low and the high of the day. It's a bit too demanding, isn't it? You may catch 10% of that, you know, depending on your trading methodologies. But it's good to know that the trading range could potentially provide up to $4,400 per day in the case of the S&P. Okay. Now, what if we do it with the Nasdaq? Well, the Nasdaq produces an average of 439 points per day, where each of those points, okay, instead of $50, are going to be $20. So $20 times 439, that is $8,780 per day. Again, if I can use a little bit of humor, if that's okay, if you were to be that super trader, amazing super trader that every day catches the low and rises all the way to the high, which again is not what we try to do here. We try to add probabilities, and therefore we want to be more relaxed than that. But let's say you are that super trader catching the low all the way to the high of the day every day. So you will produce with the Nasdaq $8,000 plus per day instead of $4,000 plus with the S&P. And it's interesting because if you recall what we just said a moment ago, well, the point value for the Nasdaq is 20, where the point value for the S&P is 50. So if you didn't look at the ATR, meaning if you didn't look at what is the normal volatility for those equity index future contracts, you would have probably thought, look, the S&P got more risk built in because it's a higher price point, right? It's a higher point value, and therefore it's higher price, and therefore, you know, I have more risk. Well, the reality is that the Nasdaq is more volatile, and even though the point value is less, actually there is more risk, also more potential for reward, but definitely more risk. Okay. Let's continue. What if we did the same with the Dow Jones? Well, if we did the same with the Dow Jones moves at a rate of 553 points a day as an average in the last 14 days. At the time of this recording, of course, this changes through time. So the point value for the Dow, if you recall, the YM is $5. Okay, so that is $2,700. So you can see that potentially this contract is a bit quieter compared to the Nasdaq and the S&P, not only because the point value is less, but actually because it's a combination of point value times the ATR value. And if we were to look at the Russell index, and you may be surprised about that because the small caps have the reputation of being very volatile. And I'm not saying they're not. Look at this huge rise in ATR at times, right? So it's very volatile. So 54 points a day. But when you multiply this by the point value, which the Russell point value is the same as the S&P 50, so you end up with a similar value as the Dow Jones, which has a reputation to be the less volatile. So again, it's not only about volatility, it is not only about the point value, it's about a combination of both that gives you a good understanding of what's in for me, potentially speaking, if I was to trade intraday, catch a move intraday. Well, it's good to know that the potential for profitability on the Russell 2,700, similar to the Dow Jones, kind of like half of what it would be for the S&P, that if you recall was 4,400, kind of like half of what it was for the Nasdaq, which if I'm not mistaken was around 8,700 or something like that. So these are very interesting calculations to do. This is not helping you to find a trade, but this is helping you to identify which market should I trade given how much I appreciate volatility, how conservative or aggressive I am, what is the size of my account, etc., etc. And finally, just to round it all up, of course, we can also add the fact that when trading equity products in the CME index, could be the Russell, you can also trade the micro, could be the Nasdaq, you can also trade the micro Nasdaq, could be the S&P, you can also trade the micro S&P, or even the Dow, you can also trade the micro Dow. And so how do you trade the micros, which are 10 times less? So 10 times less means instead of 8,700 is going to be 870. Instead of 4,400, it's going to be 440. So everything is 10 times less. How do you deal with that? Well, it's very simple. So you have ES1 exclamation mark. This is your symbol for the S&P futures, E-mini contract, which is the regular one. So you add an M in front. Now you have the micro E-mini S&P 500, MES1 exclamation mark, or MNQ1 exclamation mark for the micro NASDAQ, or MYM1 exclamation mark for the Dow, or for the Russell. It's just a little bit different in this case. I think it was M2K1 exclamation mark. Yes, correct. 2K for 2000, right? For the micro Russell. Okay. Anyway, so hopefully this was helpful. It's been a pleasure, and see you in the next video, everyone. Trade safe. Bye bye.